In this video, I'm going to show you a powerful alternative to a Roth conversion, one with far less rules, yet most people never use it. Coming up next on Holy Schmidt.
Holy Schmidt!
There's a tax bracket in this country where the rate is zero. Not low, but zero. And for about a decade of your life, you have a real shot of using it. But almost nobody does. And the reason? During those same years, everybody is telling you to use that zero tax bracket for Roth conversions, which in many situations is the right move, but in others, it's the exact opposite of what you should be doing. And the most important thing, they actually compete with each other. So if you want to use one, it's using up space on your tax return to use the other. To start, if you have money in a regular brokerage account or you plan to have money in a regular brokerage account for retirement, pay close attention to this video because this video is for you. If you don't have money in a brokerage account or the amount is small and you never plan on building it, then a Roth conversion might be the best strategy for you. And I will show you how to determine which is which. All right, let's start with a tax bracket that most people don't use correctly and why it competes with advice that you're probably hearing right now. One of the most powerful pieces of knowledge that you can have today is to really understand what you can do with a long-term capital gain. When you talk to people who are reasonably tax savvy, they understand the benefit of a Roth conversion and they know how to utilize it for the most part. At least they know the words. If you ask those same people about how to forward plan using long-term capital gains, a lot of them don't have any idea. They think it's something that happens after the race has run. So let me start off by making one simple statement that is profoundly important. Long-term capital gains, the profit of an investment you've held more than a year, don't use the regular tax brackets. They have their own. And that separate schedule starts at zero. For 2026, a married couple can have up to $98,900 of taxable income and pay nothing on their long-term capital gains. For a single filer, it's $49,450. Now here's where people get tripped up. That's taxable income. That's after your deductions have come off. So the actual money coming in the door can be quite a bit larger. Let me give you a quick example using a married couple, both age 65 in 2026. This couple can start with a standard deduction, that's $32,200. Then add the extra deduction get for being 65 or older. That's another $1,650 each, or $3,300 for the couple. Then add the new age 65 plus deduction that came online for the 2025 tax year. That's $6,000 per person, so another $12,000. Stack those up and you've got $47,000 of deductions. Add that to the $98,900 ceiling and the couple could have $146,400 of income, assuming they qualify for the full deductions, and still pay zero on their long-term capital gains. For a single filer age 65 or older, the number is $73,600. Now one important note, that's the federal rate. Some states tax long-term capital gains like ordinary income, so check your state. Now, how does any of this collide with a Roth conversion? Because of a rule in the tax code about the order that things get counted. Ordinary income gets counted first. That's things like wages, pensions, IRA withdrawals, and Roth conversions. That fills up the bracket from the bottom. Then and only then do your long-term capital gains get added to the pile. Whatever room is left underneath the ceiling, your gains get taxed at zero. Whatever spills over the top gets taxed at 15%. So think about what a Roth conversion does in the picture. It actually gets counted as ordinary income and pushes everything up. Every single dollar you convert takes up a dollar of room that a capital gain could have used for free. You didn't add space to your tax return, you just decided what to spend it on. Now let me make this concrete. Let's assume that a couple had $60,000 of ordinary income and they had up to $98,600. That leaves $38,600 for a Roth conversion or other. They now convert $30,000 to a Roth. Their ordinary income is $90,000 and the space left for tax-free gains just dropped from $38,900 to about $8,900. Same couple, same account, same year. They just traded $30,000 of long-term capital gains for a $30,000 Roth conversion. And most people doing that trade have no idea that they're doing that trade. That's the whole video right there. You're not choosing whether to use the window, you're choosing which asset to use the window on. Now let me put a number on it because this is the part that changes a lot of people's minds. Say you're in the 12% tax bracket and you convert another dollar to a Roth. You'd think that dollar cost you 12 cents. That's the whole pitch. Convert cheap now, avoid expensive later. But watch what that dollar actually does. It costs you 12 cents in ordinary tax, but it also costs you $1 of capital gains out of the 0% bracket and into the 15% bracket. So that's 12 cents plus 15 cents in capital gains. Your real marginal rate on that dollar can effectively be 27%. 27% on a conversion that you did so that you'd avoid 22% later. Gang, if you're using spreadsheets to manage your finances, you're doing it the old-fashioned way. The fact is, spreadsheets are prone to errors, and one mistake in one cell can have a ripple effect through your entire financial plan. Now, on this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. This is the personal financial planning software that I personally use. When you start with Bolden, it has a comprehensive plan builder, a quick onboarding process creating a baseline plan for you, which you can continuously update to project future changes across taxes, income, real estate, debt, healthcare, and more. You can also build up to 10 different what-if scenarios and compare as many as 3 side by side to see how your choices play out. There's also a Social Security Explorer, a Roth Conversion Explorer, forecasting, and a lot more. If this is of interest to you, Bolden's offering 2 weeks free of their full-featured software. You can use our affiliate URL, go to go.bolden.com/Schmidt, try it for 2 weeks, and if you like it, then it's only $12 a month paid annually. So what does using this window actually look like? Well, frankly, it's a lot more simple than most people think, certainly not nearly as complicated as the rules around a Roth conversion. Say you own a fund in your brokerage account. You paid $40,000 for it years ago, and today it's worth $90,000. You have a $50,000 gain sitting there untaxed waiting. In a year where you have room under that ceiling, you sell some of it, maybe $20,000 of that gain. You report it, and at 0%, you owe nothing on it. Now, here's the surprising part for a lot of people. You can buy the exact same fund back the same day. A lot of people think there is a waiting period. There is, but only for losses. That's the rule that everybody's heard of, the wash sale rule. It's about claiming a loss. It's not about gains. So you're never out of the market, at least not for very long, but your cost basis just reset permanently. And if cost basis is a fuzzy term, here's all it means. It's what the IRS said you paid. When you sell, you're taxed on the difference between what you paid and what you received in the sale. So raising the basis for free makes the taxable difference smaller. You're not avoiding tax, you're just utilizing that zero tax benefit. Now, importantly, you're not utilizing one window. There are 4 separate windows, and each is slightly different. Let me explain. Now, the window that we're talking about, or the 4 windows, begin at age 62, and they close when required minimum distributions begin. For a lot of people watching this video, that's age 73 or 75. But the window isn't the same the entire way through. And this is where a lot of people get confused because they have 4 different things happening during that 11-year period or 13-year period, and they don't fully understand why things are changing. I'm going to make it very simple for you. I'm going to show you a simple year-by-year map that JP Morgan publishes in their Guide to Retirement. It's on page 21 of their 2026 edition. Now, one other point that often doesn't get spelled out, it's not just your income that gets measured. There are other caps that you need to pay attention to. These other caps tell you how much room you really have, and they change by age. Cap number 1 is a health insurance cap that is in place until you turn 65. If you retire at, say, age 62 and buy your own health insurance on the marketplace, your real ceiling isn't the tax table at all, it's the health insurance subsidy cliff. For 2026, that cliff sits at about $62,600 for a single person, $84,600 for a couple. Go $1 over and your premium subsidy doesn't shrink, it goes to 0 all at one time. Now, when you compare that to what a tax table would have allowed for a couple under 65, around $131,100, the health insurance rule cuts your usable window roughly in half. And there's a detail that catches people with an age difference in their household, and that is the cliff is based on household income, not individual income. So if one spouse is 65 and on Medicare, but the other is 63 and still on the marketplace, the whole household is capped. Cap number 2, age 65 until you claim Social Security, and this is when you're wide open in most cases. When you turn 65, Medicare replaces that marketplace plan, so the subsidy cliff disappears entirely, and you pick up those age 65 deductions we talked about. For a couple, that's an additional $15,300. That takes you from $131,100 to $146,600. For a lot of people, these are the widest, cleanest years that you'll ever have, but most people aren't focusing in on it. They're focusing in on what happens at age 62 and what happens at age 73 or 75. And this is why the timing of your Social Security decision matters. Every year you delay is another year the window stays wide open. You get a larger Social Security payment, but don't pay tax on the increase because you haven't actually drawn Social Security yet. Conversely, you get fewer payments, they're just larger. Cap number 3, from the day you draw Social Security to the day required minimum distributions begin. Once your Social Security check starts, your window starts to close, and it closes in 2 directions. First, some of your Social Security payment may become taxable, and that uses up some of the room. Taxability of your Social Security payment ranges from 0 to 85%. That doesn't mean that you pay 85% tax on your Social Security payment. It means up to 85% of your Social Security payment can become taxable. The second, and this one's a little on the sneaky side, the long-term capital gains that you harvested help determine how much of your Social Security payment is taxable. So a harvest that used to be free can now drag part of your Social Security payment onto your tax return. Cap number 4, once required minimum distributions begin. Eventually, required minimum distributions start, and those are ordinary income you don't get to decline. They land in the bottom of the pile and push everything above them up. When you start RMDs depends on when you were born. If you were born between 1951 and 1959, you start RMDs at age 73, 1960 or later, age 75. Either way, once those required withdrawals start, it's Social Security plus your required withdrawals plus whatever else is in there, and you have very little room, if any, underneath the ceiling. So the opportunity is simple for the average person. It's tighter before age 65 because of health insurance. It's widest from age 65 until you claim Social Security. It starts to tighten after that, and then once you reach RMD age, it goes away. And the one thing that you don't need to worry about, at least when it comes to what we're talking about here, is IRMAA surcharges. Medicare surcharges, called IRMAA, are a real thing. If you earn too much, your Medicare premiums go up 2 years later. But the good news is that the first IRMAA cliff, if you're married filing jointly, is $218,000. If you're single, it's $109,000. Now recall that the harvest ceiling for a married couple filing jointly, $143,400, $76,600 if you're single. So for the strategy we're talking about, IRMAA generally isn't a big deal unless you have a lot of tax-free income, because IRMAA's calculations add in tax-free income. An interesting side note though, IRMAA is exactly what trips people up when they're doing big aggressive Roth conversions. Now, when is a Roth conversion still the right answer? Well, fortunately, it's pretty easy to tell. There are 2 specific situations. The first is who ends up with the money, and it's about the cleanest test I know. When you pass away, the investments in a brokerage account get a stepped up basis. So the person inheriting those assets doesn't have to pay tax on the growth in the account. So if you're never going to sell the account, it's going to the kids, then harvesting long-term capital gains really doesn't make a lot of sense because they're going to get the stepped up basis anyway. Now here's the flip side, and it's an important one. If you don't convert your IRA to a Roth, when the time comes and they inherit that IRA, the inheritance will come with a tax bill attached to it. So for the person planning to leave money behind, the whole thing inverts. Don't harvest the brokerage account, the step up handles it. Do convert the IRA because nothing is going to handle that one. The second case is much simpler. If you have a large IRA and genuinely low tax bracket now, those required withdrawals are going to be big, and they're going to be forced, and they're going to be taxed. Converting ahead of them can absolutely be worth it. So it comes down to one question. Are you going to spend the money, or are you going to leave it for your heirs? If you're going to spend the money, then utilizing the long-term capital gain strategy could very well be worth it. One last point, a deadline that is very real. The additional $6,000 per person, $12,000 per couple, 65 plus deduction is scheduled to conclude after 2028 unless Congress extends it. So make sure you factor this in when you're planning for the future because it could change after 2028. If you like this video, check out that video. Retirees, if you have a paid off home, you now have a big fraud risk. Do this ASAP. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt for your 2 weeks free. This is Jeff Schmidt, and I will see you in that video right there.